Welcome to the live stream. I'm Mitch Goldberg, your host. I'm a wealth advisor, financial advisor with Client First Strategy. Thanks so much for joining me. We haven't been on for a few weeks, but if we're just getting to know each other, everyone calls me Mitch. I'm a financial advisor with the wealth management firm Client First Strategy. And what we do is we help our clients plan and invest for future goals. We help clients with personal finance. We help map out a plan. We help clients go through things like bank statements and credit card statements and really find money leaks and help people truly get back on track with what they're doing with their money and how they could build wealth. It's not just about investing, it's not just about finding the hot winners, it's not about finding the next big winning stock. A lot of people like to go for that Sunday punch to make up for years of financial neglect. What we want you to do is not relying on a Sunday punch. We want you to do the right things with your money to grow your wealth over time to the best of your resources. Optimizing your resources. That's what I think is a good way. Uh, it's a good way to describe this. Couple of things I want to just get into today. First and foremost, welcome to 2025. The calls have been coming out for the last 6 weeks about what the market's going to do, the stock market, in terms of 2025. And it's all over the board. Some people are saying, look at below. Some strategists are saying, we'll have a good market until the middle of this year, then it's going to go down. And of course, you get the good one. The market could continue, but we could see some volatility too. Like these are BS answers, by the way. These are just from people who don't really have a clue of what to say. They're asked a question on TV and they want to give a smart answer. So they talk out of both sides of their mouth. It could go up, but there could be volatility. That's like saying maybe it'll go up, maybe it'll go down. So if it goes up, they could say, I told you so. If it goes down, they could say, well, I told you there could be volatility. You know, it doesn't really help you, and it's not really a it's not really an answer that's going to help. I think the smartest answers, and there are a few strategists who've given what I think are pretty good answers, but the type of financial advisor answer that you would expect that I would give you, that many of us financial advisors would give, you're not going to find really on TV because TV is made for eyeballs. It's made to get attention. I've been on TV many times. Uh, I give the advice I give. I give my thoughts and opinions, and usually it's not the most exciting thing in the world, but people want to know what they should do now. People like to be told what to do. They just like to be told, you should invest in financials now. You should pick up oil stocks now. You should continue to stick with the magnificent seven stocks like Nvidia and Meta. Keep riding them higher. You should take profits on those stocks and diversify the money into something else. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I have what I think is a really reasonable outlook for 2025 that I think could do a lot more for you than trying to decide if you should buy more stocks, buy more of the winners, sell the winners, buy the losers. It's endless what the advice you could get. So let's roll a quick intro. We'll talk about this. I just want to inject some common sense into the conversation and not get too carried away with everybody trying to sound like they know something. They know what's going on. Here we go. Stick around. We're going to be off in about 5 minutes, please. Thank you. Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. We're just getting started here. And I want to give you what I think is the common sense, smart advice for 2025. I'm going to start by going backwards to the election we just had in November. It was what, 2 months ago that we had the election, and right before the election, I held up a sign on the side of the road on Route 110. If you're not from around here, Route 110 is a major commercial thoroughfare on Long Island. And I basically said, I'm not changing anything due to the election. And I wrote a post on social media saying that, no one has a goddamn clue. We had, people said if we have inflation, the market's going to go down. We had inflation. The market did pretty well. Overall, in all, under Biden, the market did pretty well. It did pretty well under Trump, too. It did pretty well under Obama. There's only two presidents that saw a negative stock market from start to finish in their time in the office. That was Hoover, and that happened to coincide with the Great Depression. And then there was George W. Bush, the second George Bush, who was president from 2001 to 2008, 2009. Okay. So that were the only two losers. And the second Bush was the Great Recession, the tech wreck, 9/11. It was just a really tough time for investors. Complete opposite of what investors are seeing now, where it seems like it's easy and people are making money every day. I think people buy a stock because they see it going up. It goes up and they feel like, well, I must be good at this. I must know something. No, you did not become smarter. People are chasing the winners. Now, maybe there's some intelligence to be said to chase the winners or to keep buying the dips. Maybe there's intelligence to say, if you've made what I call obscene money in stocks, and I have them too, okay, let's take a little off, maybe sell a couple of shares, go into something else, diversify a little bit. The calls are all over the place. I think the common sense thing is, going back to the election, I wouldn't make any changes in my portfolio based on the election. Too bad people sold stocks because Biden won or because Trump won, because you would have done well with both. And I'm going to say the same thing now. Don't make your decision based on your ability to forecast interest rates, the economy, labor reports, corporate earnings, geopolitical events. These are all the worries, and we love to talk about this could happen, that could happen, this could happen in Ukraine, this could happen in the Middle East. The possibilities are endless. I actually hate that phrase, the possibilities are endless. It sounds like a good marketing phrase, but really we have to deal with probabilities. If you deal with endless possibilities, well, the earth could get hit by a big meteor and we could all perish. So, is it likely? No. So and if that happens, none of the planning is going to really matter anyway. So let's just look at probabilities. The probability is that the stock market has a strong upward bias. Companies get bigger. Believe it or not, this goes counter to what a lot of people think. Inflation is not bad for the stock market. Inflation means companies get to raise prices to maintain their earnings power, which is exactly what we're seeing, right? You see prices go up, people are spending, companies are making more money. So a lot of people have this backwards. So if we have a spike in inflation, it's going to be really bad for the market. The Fed raised rates to the highest level in decades. Stock markets still worked out pretty good the last 2 years. We'll see how it goes for 2025. My goal for 2025 is to keep on doing what I was doing for the last 30 some odd years of my career. My clients will remain diversified. The timing of when they move out of stocks, in other words, so you have stocks, you might take profits on stocks to buy new stocks. Maybe stock goes down, you could buy more of a stock, but you're staying in the stock market. Your money's being reinvested. At some point, you start to stop reinvesting into the stock market, either through dividends and capital gains, or sometimes you just, when you sell a stock, instead of buying any stock, you buy something else. As we get older and we get closer to that point when we could need our money from the market to live on, eventually you turn your investments into income. The closer that gets, the more we start to get out of the stock market and get into more stable investments, cash, cash equivalents, short-term bonds, income-producing assets, that sort of thing. It's not based on, well, I think the market's too high. It's not based on who the president is at the moment or what the policies are. And things are going to change. We're finally getting into real policy. The inauguration day was today. Not the vote. The certification was today. Inauguration is coming up in 2 weeks on the 20th, and we'll start to get into policy. The Washington Post reported that Trump wants to tone down his talk about tariffs, about being aggressive. But then Trump said in a social media post, that's not true. I'm going to be very aggressive with tariffs. Maybe he's using tariffs as a bargaining chip to try to get what he wants. Maybe he's using aggressive talk to get NATO to pony up more in defense spending, which actually he got them to put in more money into defense spending. So we have to see what is at stake. We have to see what the reports are going to be, what the news, what the politics, what the policies are going to be, what gets voted on, what makes it through Congress. But this is all a sideshow. Let me explain some of the things that make a big difference for you. Because all my adult life, I'm 57 years old, so that's a lot of adult life now. I've heard elder statesmen say to me, if this person wins an election, it's bad. If that person wins, it's bad. If this tax policy gets through, it's bad. If that tax policy gets, there's always something negative. But the stock market has continuously climbed up. And for those who just focused on their career, focus on the family, and practice good investing in personal finance habits, did very, very well. So here's a couple things that you could do, especially now that we're all going to be getting our credit card bills over the next week. And I like to say, if your holiday joy disappears with the when you receive your credit card bill, you're doing something wrong and you've overdone it. You have to get out of the habit and thinking that you could spend a lot in 1 month and you'll make up for it with low spending in the next couple of months. It's number one, because it doesn't happen. The novelty of the new toys goes away. The novelty of the vacations, of the fancy dinners, it goes away. Now, I'm not saying you shouldn't take special vacations with your family. I'm not saying you shouldn't have nice dinners. But what I am telling you is, if you are spending a lot of money because you think you'll make up for it in the next couple of months with lower spending, I've seen so many people try that, and it often does not materialize. The other thing is, what you could do is consider increasing the contributions to your retirement plan. The amount of money you could put into a retirement plan has gone up a little bit. So you should be looking to put more money into your retirement plan. If you're not participating in a retirement plan, you could always do an individual retirement account, an IRA, maybe a Roth account, maybe a traditional IRA. There's a difference. We could talk about that another time. Maybe you need to convert some of your IRA money into a Roth IRA money. I think these kinds of decisions will get you much further ahead in your wealth building process than trying to pick the next crypto investment or the next crypto stock or the next artificial intelligence stock. I see people trying to buy the next NVIDIA. I remember a long time ago, people used to try to buy the next Microsoft, the 90s. I want the next Microsoft. How about just buy the Microsoft, right? And maybe NVIDIA's too high, maybe it's not. I could make a really good case for both, that NVIDIA could keep going higher and it could go lower. And that's why somebody like me, when I take the right client who's made, I'm going to call it obscene money in a stock like NVIDIA, some people should take some profits. I'm not saying sell the whole thing, but there are some clients who just cannot afford to give all that money back. The money they've made has really managed to give some financial security to some people. And if that's you, you should consider taking profits. No one's going to ring a bell. We don't know what the right time is to take profits. We don't know if their next earnings report is going to be the peak in the stock. We don't know if another competitor is going to come out with a better chip. We don't know if by the end of this year you might start seeing a slowdown in artificial intelligence spending. We don't know. And that's why we do things like we diversify. And that's why we rebalance. We take profits out of one area and put them into another area, another kind of investment, because we don't know. What you have to know is if the stock market was to go to hell in a handbasket and interest rates were to spike and all these stocks lost 30 or 40% of their value, how would you react? How would that change your financial security? These are the questions that we have with clients. And when they say that would be really bad or that would impact my financial security or I don't think I could handle that, I like the amount of money I have. Most of our clients today, most of our clients have more money than they expected to at this time in their life, whether if they're 50, 60, or 70 in that age category, because they've made so much money in their home and they've made so much money in the stock market. They just never expected to make this kind of money. Those are the ones who also stuck through with the market in 2007, 2009, with the pandemic, election stuff, politics. They've stayed with it. Those 40 and under, it's a struggle because you're at a point in your life where you haven't yet accumulated assets. You're more of a Johnny-come-lately to the stock market and to the housing market. So you're paying up a lot and you really, you haven't had the last 20 years of gains under your belt. I get it. But in my entire career, very rarely has the stock market or the housing market ever been cheap. When the stock market was cheap, it was because of a disaster, because of the Great Recession. So it wasn't cheap. The stock market was on fire. Turned out to be a good time to buy. But PE ratios were high because earnings went down. So even though stocks were down, because the earnings were lower, the PE ratios were higher. So the stock market is never cheap, and there's never going to be a special moment to buy. You could wait for it. You could say, I'm going to hold on to some cash. The next time the stock market goes down, I'm going to throw my money into the market. No, you won't, because there'll be a good reason for the market to go down. You'll be scared, and you'll just wait for the market to go lower. When the market goes back up, you'll say, I could have bought when it's lower. I'm going to wait till it goes lower again. And it just becomes endless procrastination. This is why both for real estate and for the stock market, it's not timing the market. It's time in the market. Let time do its thing. You think the stock market's expensive now? Wait till you see how expensive the stock market's going to be in 20 years. That's a famous line, by the way, that Warren Buffett used to say. I don't know if he still believes it. I think he does. Now, Warren Buffett does have a record amount of cash on the books. So maybe he sees a very expensive market and he would rather put his money into 4% T-bills than in the stock market. He still has a lot in the stock market, don't get me wrong. So you have to decide what's right for you, how long you're going to be invested for, how much ups and downs, volatility, how much ups and downs can you take along the way before you feel like you're psychologically forcing yourself to sell or lose sleep. These are the things that you need to master. And these are much more psychological than they are numeric or quantifiable. The qualitative aspects of your demeanor, of your ability to shrug off a down market, just go about your business, that is what gets you far with building wealth. It also has a lot to do with patience. A lot of people just feel like if they're not making 40, 50% short term because they've made some money, quick money in crypto or NVIDIA, other big stocks, they people think they should be making money much quicker. This is an unusual time in my career. I have never seen so many really big companies stocks. I've never seen so many big company stocks go up so much so fast. There's always that one or two big winners in a bull market, but this is really, if you don't know, this is a very unusual time. I'm glad you're taking advantage of it, but we don't know when it ends. We don't know when it switches to other sectors. When I say it ends, I don't mean that the market goes down and everything turns into a wasteland and we go into a nuclear freeze, nuclear winter. What I'm saying is ultimately the winners change. And the biggest winners in each decade are usually different than the winners of the previous decade. So maybe we're still in the roaring 2020s. We don't know when it ends. And that's why I'm not trying to be negative. You don't know when it ends, so don't do anything. I'm like that. I'm very into embracing risk. That's my job, right? It, if you don't want to take any risk, you really have no reason to work with me. I am in the business of risk, but I'm also in the business of risk management, but I'm really in the business of helping you earn a rate of return on your money that could exceed that of inflation, and then help you decide what you could do with your money. Should you take money out of an IRA right now? Should you convert an IRA to a Roth IRA? Could you do a backdoor IRA, backdoor Roth IRA right now? Do you know your tax bracket? Should you put more money into a 401k or maybe switch to a Roth 401k? The biggest issue I have that I see with clients with really substantial 401ks is that all of that money is taxable when they take the money out. And people have millions in their 401ks, but they don't have it in a Roth 401k. So they're going to just keep getting crushed on taxes when they're in retirement. It used to be you were in a higher tax bracket when you worked, you went to a lower tax bracket when you stop working. But there are so many multimillionaires with 401ks that the taxes are going to continue to be high for these people, and their assets could be depleted earlier in life because of that. So these are the kinds of things that we're talking about that we go over with clients. It's not should you buy stock A or stock B because that's going to make you the most amount of money. Of course, I want you to make as much money as possible. And there's limits to that. It depends on your risk tolerance. The more money you try to make over the shorter term, the more you better be comfortable with taking the risk to do that, meaning seeing it backfire, go down a lot, and possibly never recovering. When I talk to people and I describe risk that way, people often take a step back and say, well, maybe that's not the risk I wanted to take. And I like that because I like to think I'm a good communicator and I could help you open your eyes to the risks that you're taking. Now, last thing, I look at exchange traded funds from small cap, mid cap to large cap. And it's just overwhelming how much exposure investors have to the technology sector. Now, it makes sense that investors would have more exposure to the technology sector than ever before, because technology makes up a bigger and bigger part of our economy than ever before. So that totally makes sense. However, technology stocks have always been subject to boom and bust periods. And this is why we preach rebalancing. We say, sometimes a stock is too big a portion of your portfolio. Sometimes we'll say, hey, you're up 1,000% in a stock. It might be a good idea to take just a little bit off the table, put that into something else that's different. I don't mean to sell NVIDIA, for example, and buy AMD or Broadcom. That's not what I mean. If I'm selling a tech stock at this point for a client because they have too much money in tech stocks, I'm not buying another tech stock. I'll look at industrials, I'll look at financials, maybe I'll look at fixed income, emerging markets. There's lots of things, lots of investments to look at. But I personally, I like to invest for diversification, and I let the process play out. Let the stock market, the global financial markets, let those do their thing, and I'll just trust the process and surrender the result, which I expect will be pretty positive many years from now. All right. If you need help with this sort of thinking and you need a realignment in your head in terms of how to invest, how to think about your personal finance, things that you could do starting now that could help you improve your well-being financially. And if you improve your well-being financially, you're probably improving your well-being psychologically as well. If you can use some help with that, then definitely reach out to us. We'd love to hear from you. Okay. I'm going to end it there. Have a great night. Thanks so much for listening. If you have any questions or you want me to talk about something, hit me up in the comments and I will speak to you tomorrow. Thanks.